Welcome class 11 commerce students. Today I will continue with the chapter that I have started in my previous class, that is business finance. Business finance. Last day I have taught you about the classification of funds on the basis of time period. So today that day due to shortage of time I cannot complete, but now I will try to complete these categories, different categories. So first one, describing with the first one is long term source, long term source. So I have told you various long term source this finance is required to make permanent investment, and the long term finance is required depends on the type of business, and also the time period is 5 to 10 years. Long term source is available for 5 to 10 years. This investment is made within this time period, and the sources are equity shares, preference shares, debentures. Then comes the medium term fund. The sources of medium term funds are long-term loan from bank, debentures, also public deposits. Also public deposit you can add with this, and the time period is based on also public deposits, and the time period is up to 5 years. Up to 5 years. And then comes the short-term fund, and I have told you that short-term fund sources, these are required to purchase raw materials and payment of wages and all that. They can be raised for only 1 year within a span of 12 months only, and there are various sources of short-term fund, saying trade credit, factoring, brokerage, banks, commercial paper, installment credit, ICDs. In this way, discounting of bills. In this way, many types of short-term funds are also there. So this is a classification based on the basis of time period. Now funds can also be classified on the basis of generation, sources of generation, on the basis of sources. So on the basis of sources, funds can be classified. On the basis of sources, funds can be classified into two broad categories. Here two broad categories are there on the basis of sources. First one is internal source. Internal sources, and second one is external sources. So these are the two broad classifications based on the sources. So first I will talk about these internal sources. The sources of funds which are generated by the business itself are known as internal sources of funds. For example, collection of receivables, depositing of surplus, stocks, plowing back of own profit, which is called retained earning. These are the only limited sources of business finance, and is fulfilled by, and the requirement of finance is fulfilled by these internal sources only. Now comes the external sources. Now the name external means from outside. External sources of funds lie outside the organization. Internal sources of funds lie inside the organization, but external lie outside the organization, as you can clearly see from their name given. The sources of funds that lie outside an organization are known as external sources of funds. For example, loan from commercial bank, financial institution, issue of debentures, public deposits taken, lease financing, trade credit, factoring, etc. Requirement of large amount of funds can be utilized from these sources. Very small fund is utilized from internal sources. Large amount of fund is utilized from external sources, because whenever internal sources are never ever sufficient to meet up the all financial requirements of a business. So whenever these internal sources are not enough, which is not enough to meet up the total financial requirement of a business, So external sources help is taken, and external source, from this external source, huge financial requirements are met up through this external source. As a loan, it is taken from outside and it is used to meet up the financial requirements. Internal sources can never be enough. It can never be adequate to meet up the financial requirements. So in that case, internal sources as well as external sources, from external sources maximum capital is raised, which are, I have told you, the loans from bank or other financial institutions, or lease financing, public deposit, issue of debentures, etc. So these are the two classification based on sources. Now comes the classification of funds based on ownership. Based on ownership also, there are two broad classifications of fund. What are those two classification? One is owner's fund, another is borrowed fund. One is owner's fund and whereas the other is borrowed fund. Now I will talk about these two funds one by one. First is owner's fund. Now owner's fund refers to the funds contributed by the owner as well as taken from the accumulated reserved profit, reserved fund of the company itself. So owner's fund are the own fund of any company. It is given by the owners and contributed from the profit of inside the business. Company's own profit are kept aside as a reserve. That profit is called retained earning, that is a surplus income which is left over after making payments, all the interests, making all the payments, a certain sum of profit is left over. That is kept as a retained earning and set aside in the business, and that finance is used by the business whenever it is required. That is called owner's fund. So that fund is the owner's fund. That is the own capital of the company, and that is called owner's fund. The fund remains with the company as it has no liability to return. And also with that, equity shares. Equity shares are the owner's own capital. Equity means owner's capital. So equity shares, retained earnings, these two are the owner's fund. Now let's talk about the borrowed fund. What is a borrowed fund? Obviously, borrowed fund, owner's fund has their own advantage and disadvantage that I will explain you in my next class. Now comes the borrowed fund. Borrowed fund, as the name suggests, the fund has been borrowed from outside. This fund refers to the borrowing of the firm. It includes all the funds available to the firm in the way of loan and credit. So it has to be returned after some time. So these comes from issue of debentures, public deposits, loan from banks and financial institutions, etc. So you can see clearly the difference of owner's fund and borrower's fund. Owner's fund is the own fund. It is taken from company's internal sources, whereas borrowed fund is taken from outsiders of the business, the creditors of the business. It is borrowed, it is taken as a loan. This borrowed finance is taken as a loan or as a credit from outside the company, and after the expiry for a certain period of time, an interest is paid as a payment of loan. Interest has to be paid regularly at regular intervals, and after the expiry of a certain time, this borrowed fund has to be repaid. This borrowed fund has to be returned because it is taken as a loan from the creditors, and loan has to be returned. It is a liability of the firm. Firm cannot keep it for a longer period of time. After the expiry of a certain period, it has to be returned to the creditors. This is the difference between owner's fund and borrowed fund. Also, I will discuss about the advantage of owner's fund and borrowed fund in my next class. So wait till my next class. Till then, goodbye.